Well, a quick welcome to all those who are joining at least 1 minute early or so, and so glad to have you here. We've got probably about another double that we expect today, although they're coming in quick now. So probably we'll wait another minute or two so everybody can join, and then we will launch right in. But I always like to check the most important thing of any Zoom or webinar platform. I want to make sure you can hear at least me and see our screen, so you can maybe either raise your hand or if you want to put a little thing in the chat saying that's the case. So
looks good.
Good, thank you. Got a chat and hands. I like it. Better be like the belt and suspenders. So I'd rather do that. I think we've all had the not so glorious experience of telling all of our good jokes when we're on mute or people can't see the screen and all of that good stuff. So always good. I have learned through past scarring to check early, make sure that that's the case. So again, we'll wait another minute or so, and then Ryan and I will take us through the subject matter for today. So yeah, thank you for raising hands up there. See, wait another few seconds. All right. Well, I think we're going to go ahead. So there'll be obviously some that will pop in. So welcome. I am Brian, Charitable Solutions, and have my partner Ryan Raffin on as well. So he'll be co-presenting with me today. If anybody has experienced life-altering webinar series that Charitable Solutions provides, obviously a joke. We do provide sort of a somewhat of a set routine here. Not sure if it's the best, but it's sort of what we do. So we do not send out slides. Again, without going into this too deeply, we've had a couple people repurpose our slides, let's just say for their purposes, which has not been a joyful experience. So we do record this and put it on our website for free. And yes, if you want to go be nefarious with the slides, you can just watch the recording and recreate your slide. But I have learned that many humans are lazy and they won't do that. So it's easier for them to cut and paste and slap their logo on something and send it along. So hence the recording. We did this webinar on Tuesday, and very oddly, that one actually went quite well. So I mentioned to Ryan that one probably is a keeper. But we'll see if this one goes better, then this will be the keeper. So we typically do a Tuesday, Thursday session, as you may know. We record, again, the webinar, and then that is on Charitable Solutions, LLC website under Resources and Webinars. So I think we have maybe 8, 10, I probably should know, past ones that are on there. So if you this is your first time and you want to learn more about some of the odd things that we do that can be maybe helpful in your practice or your development career, definitely feel free to go back and revisit those. So bottom line, no slides, but we'll be providing early next week 2 things. One will be a link to the webinar on the resource page, and the second is that I would encourage you to ask any questions in the Q&A, ideally versus the chat. We can kind of pull that too, but ideally in the Q&A. And then what Ryan does is he takes all the Q&A from Tuesday, all the ones from today, and then we'll sort of dedupe and compile those into a Q&A for both sessions. So we'll have both the questions and then our answers. So then within the webinar, you sort of go to the link, and then right under that are the Q&A for the session too. So hope all this is helpful. We will jump right in. So highlights, trends, and 5 creative case studies from 2020. I think first, very glad we're all in 2021. My wife sort of made the comment like January 8th. She's like, I thought 2021 would be much different than 2020. I don't know why. I sort of thought the same thing. So we're not exactly out of all of the muck, very unfortunately. But in any event, I was blown away personally by what I would call almost irrational level in a wonderful way of amazing generosity last year from so many donors. So releasing very large gifts into, I at least would submit that it's the most volatile year in my lifetime, and people still gave. And so it was wonderful to be a part of that to the extent that we could help facilitate those gifts, and many on the call worked with many incredibly generous donors doing the same thing. So while there were a lot of negatives to 2020, there were some pretty amazing positives too. So with that, we'll jump right into the agenda. So we'll be talking about, again, trends and highlights. I'll be talking about that. We'll have Ryan going through cryptocurrency donations, sort of a hyper trend in the last 45 to 60 days or so. I will talk about some foreign real estate gifts. Ryan will jump in on more of the domestic testamentary gifts. He will then discuss S-Corp donations, and then got a case on gift annuity reinsurance on a very large gift annuity. And then we've got sort of a bit of a potluck catch-all on some other interesting donations that are sort of popped up, and I've had two pop up in the last day and a half. So if we've got a bit of time, I might mention that. We crave questions, and so while you're all muted, I understand. But if you can, in particular, I think either at the end of each slide, so there aren't going to be 50 slides, but at the end perhaps of the trends, if you have any questions there, or certainly after each sort of case study slide, feel free to put that in the Q&A. And if I am the one presenting that, then Ryan probably will be the one responding, and vice versa. So, and if it's very specific, we'll definitely get back to you either directly, or we'll make it a bit more generic and include that in the overall Q&A with the answers that come out next week too. So with that, let's jump right into to the session here and go right into trends and 2020 highlights. So first thing is around trends. This has really been an acceleration of what we have experienced from our very weird perch. It's a very odd place and role that or lane that we inhabit, but we are seeing more and more of these private business transactions and real estate donations from the baby boomer generation. And whenever I talk with other advisors or other gift planners, fundraisers, it's like, yeah, we kind of are hearing about that too. We are seeing just crazy amounts. And you have really a perfect storm that has developed and sort of continues brewing in a good way. So there's like a bad perfect storm, and then there's a good perfect storm. This is a good perfect storm. You have people now roughly 65 to 75. They maybe purchased a rental duplex, 30 years ago, and then maybe that appreciated, and then 25 years ago they rolled that into a, quadruplex or something. I'm making all this up, obviously, on a 1031 like-kind tax-free exchange, and then they did another exchange, like 12 exchanges later. Each time you do that, you do a carry-over rollover basis. You continue to depreciate the property until such time as now the property that they have at this point at, let's make up 73, might be a 25-unit apartment complex. That might work wonderfully from an investment perspective, but that same 73-year-old is saying, I'm kind of done. I'd like to declutter. I'd like to be able to sort of reduce my overall sort of lifestyle burden, et cetera, but I've got zero cost basis in a long-term gain property. So you sort of have that person. The other person, maybe his or her brother or sister, started a privately held business, perhaps bought into one, maybe a C Corp, S Corp, which we'll talk about, LLC. And then those continue to grow over time. And now you've got the same person, 65 to 75, saying, I think it may be time for us to start business succession planning down to existing current owners, or perhaps a direct merger or acquisition, but in some way of exiting, creating a liquidity event for that particular interest. And what generally are their sort of cost bases, I guess, in those types of assets? Crazy low. All you have to do is like crazy, crazy low. So you've got real estate that's sort of been depreciated over long periods of time. Even if they bought maybe a 20-unit apartment complex in 1973, their basis is zero, even without all these 1031 exchanges that we see so frequently. So why am I saying this is a perfect storm? You've got baby boomers, big chunk of the snake, sort of working their way through. At the same time, they have these kinds of assets, like a lot of these kinds of assets, crazy low basis, looking for liquidity or exit in some way. At the same time, this is sort of the big part of the perfect storm, you have got insanely low interest rates. We all know, like, super historic lows that's ever been recorded since the beginning of time. What does that mean? Cost of capital really low, which then means what? Demand and capital appreciation, sort of a derivation of that very low discount rate or that interest rate, creates more buyers at a higher price because they're able to borrow crazy cheap and therefore then be able to buy these businesses, buy the real estate. So you have the asset, perfect storm, you have the person sort of age range, perfect storm, and you have tons of liquidity to help facilitate that sort of transaction. So this is, when I say it's not like, oh, it's gone up 3% from the year before, this is like kind of, again, parabolic in this space from everything that we are hearing. So that is a macro, mega, super, whatever you want to call it, but from a charitable giving standpoint, all you know is perhaps the most charitably inclined donors, and this is so important, I say this on every non-cash webinar that we do, every one, the most charitably inclined donors always are real estate wealth and privately held business wealth. Always. Big city, small city, I don't care. Real estate and privately held business wealth. It's not generally publicly traded CEO type wealth. It's not lottery, but it's none of that. And what do real estate people own? Not a trick question. Real estate, privately held business, you get the picture there. So you're having then all of that very generous people with very low cost basis, highly appreciated long-term gain property that they're looking to exit. They don't give generally the whole thing away. They might give 20% undivided interest in their apartment away, and they hold back the other 80%. So you know all of this. Our nugget here is it's not theoretically happening. It's happening like crazy. So that's the big one. Next one, I'll spend a lot less time on, I promise, cryptocurrency. There's the whole discussion. So Ryan will be taking us through a case study there. If you've actually climbed out from under a rock at any time in the last 60 days, you've probably heard cryptocurrency like 18 times a day. So a lot of activity in that space. Some negative comments, some very positive comments, some positive changes that Ryan will discuss here too. So we're seeing a lot of that activity. I think literally, I guess tomorrow, I'll just meet today, another $1 million Bitcoin coming into our Decamai Foundation tomorrow. Small organization, could not receive it, referred it over. They're trying to buy their building, and then so we'll take the $1 million in, get it sold, transfer it over to them 30 days later so they can buy their building as a nonprofit. So just that's happening tomorrow. So impact private equity investments. We are getting more donors, not like hundreds, but big donors who are hedge fund managers, private equity investors, real estate investors who are saying, we would love, if we could, we would love to be able to have, let's say, a donor-advised fund, but not invested in more traditional investments, but instead we'd like to be able to recommend either a very large publicly traded company, concentrated risk, or a direct investment into a private investment, private company, or into real estate. So Ryan actually has a very interesting thing on the other items around an SPAC investment directly that we've made for a donor. So now we're getting more esoteric. It's not just a direct sort of kind of IPO type investment, but it's a special purpose investment into that position too. So bottom line is they're saying we made our wealth in this lane. We see opportunities perhaps that others don't get in this lane. And if there's any way that we could sidecar our charitable funds into similar type investments, we would like to be able to do that. Not with all of them, but with some of our overall charitable portfolio to hopefully increase that return, thereby increasing grants too. And the final one are gigantic gift annuities. So we're talking about that on the reinsurance one. I've been in this business 27 years, and I think the first roughly 13, almost works out oddly, but half of that, I've been involved with, I think, two or three gift annuities over $5 million or more, so 2 or 3. That would take you till about 2008, 2009-ish. From that point on, I think we're up to about maybe 25, 27 gift annuities of that size or above. So what we're seeing is big trend, both in the testamentary side, where people are saying, I'm a donor, I'd like to leave money to my kids, but I don't want to create necessarily a spendthrift trust and a trustee in the administration. Ugh, I'm kind of charitable anyway. Why not just create a testamentary gift annuity for my 3 kids? And if they die early, God forbid, then that just pours right back into my fund or goes right to the grant to the charity or charities that I want to give to anyway. It's a wicked simple, as you all know, gift annuity contract. You don't have a trustee. You don't have all that other shenanigans. I'm not saying it's perfect for everybody, but there are some big, like big. So we worked on one with the Community Foundation 4 years ago, $27 million gift annuity, 2 kids. So this one we worked on a month ago, $15 million gift annuity, which will be part of the case study. We are seeing huge gift annuities because those advisors on the phone today, the development directors on the phone today, we all did CRATs in the late 90s. And many of those, certainly that outlive life expectancy, are all exhausting. And more advisors are saying, we don't like that. We want to be able to have a contractual guarantee backed by all the assets of the charity, which creates other issues, which you all know. But the point is, they're saying we want a simple solution that would otherwise generate that return that can't exhaust. And so many big gift annuities clearly would have been charitable remainder annuity trusts through the whole 90s and probably until mid to late 2000s, frankly. And that has completely switched, where more and more large ones that would have otherwise been CRATs are now gift annuities. So next slide, we'll talk very briefly about sort of highlights. So normally during these webinars, we go through all the various things that we do. Here's sort of a quick little highlight piece. So non-cash assets for 2020, so $361 million that we completed. So important, I say this every time, 100% of those donations, there were 97, were initially declined by the charity that referred it to us in the first place. We do not do direct marketing to advisors. We do not do direct marketing to donors. We are always supportive on a case-by-case basis for the charities that we work with. So what does that mean? $361 million was declined, or they said no to the donor. But here's an option. We are not the only one. There are a number of others that do similar type work. Many community foundations, many others. My only point, which I've been sort of on this soapbox for a long time, is don't say no to a good donor wanting to do good things with a good asset. And so by not saying no, again, a little bit over $360 million was completed. Interestingly, that number is up. I think it was 78 gifts we did in 2019-ish, so it was up about 20% in 2020. I mean, again, you can't get more crazy than that. So about 25% or so from the number of donations. And the size of the donations, too, if you look at the last 3 years, we've now done over $1 billion in donations. So over $1 billion in the last 3 years. For the prior 15 years, we've just had our 18th anniversary. Prior 15 years, we did $500 million. So when I talk about this stuff going straight up, it's going straight up in this non-cash asset space. You see $3.5 million is the average. That's actually lower than the last 3 years. Last 3 years has been about 4.3 million or so. So slightly down on average, but 25% more gifts. Gift annuities, so we have Mike Carey, so part of our National Gift Annuity Foundation, on the phone here today too. So 76 new gift annuities to our National Gift Annuity Foundation. 44 million now in our pool, so we're at about 25% or so. We've got about 300 charities or so who have not only referring, but have referred at least one gift annuity. And just like our non-cash, 100% of the remainder for CGAs goes back to the charity or charities that the donors direct. For our non-cash, obviously we charge a fee. I think our fee last year was 1.6% was our average fee. And then all of the rest 30 days later is going out. So we're just, again, a giant flow-through or conduit for within a donor-advised fund platform, certainly in best practices and policies, but to be able to then support the charities that the donors were trying to give it to initially. Total foundation assets now about $675 million. We have about a 50% payout rate relative to contributions in, about a 30% payout rate on all assets. So again, as soon as it's liquid, it's going out. So we don't have any other options there, as you know. So CGA Risk did 8 pool risk audits, a little bit down from prior years, 82 reinsured gift annuities, qualified appraisals, so 82 life insurance appraisals, do some portfolio audits, maybe one every other month or so for those pools, and then 35 virtual currency appraisals. So we're still doing cryptocurrency. That was through 2020. I've done well over that since January of this year. So they're coming in about roughly 10 a week right now. So a lot of, again, activity in that space. And finally, the only thing that was down was the speaking engagements. So we did a little bit over 200 speaking engagements in 2019 and down to 43, all of which were like this virtual DIN. So at least that just gives you the highlights of, again, the odd things that we do. Our entire mission is to help make gifts happen that otherwise wouldn't, period. And so if we can do that, make it super efficient, tax compliant, risk managed, that's why I started this January 15th, 2003, so over 18 years ago. So with that, we'll jump right in, and I think, Ryan, you'll take us through the first case study.
Yeah, sure. Thanks, Brian. So first thing we wanted to talk about was Bitcoin donations, and I've got kind of a two-part presentation here where I'm going to talk about the general process and how it normally works for a standard Bitcoin, and then I'm going to talk about a little more specialized gift that we did last year with a non-Bitcoin cryptocurrency. So as Brian mentioned, Bitcoin's been in the news a lot lately, the last 60 days, except for this week where it seems to have been replaced in the news by GameStop. Bitcoin was trading very strongly at the end of last year, similar to how it was at the end of 2017, but much more so. It easily eclipsed its previous highs, going as high as $40,000 per coin earlier this month. So the run-up has continued into 2021. It has declined and gone back down to about 30,000 per coin over the last week or so, and that is largely due to some comments that the new Secretary of the Treasury, Janet Yellen, had made, which suggested that there was perhaps going to be some federal regulation coming for cryptocurrencies. On the other hand, a very positive piece of news was that PayPal is now able to do Bitcoin transactions, and anyone can actually buy Bitcoin using their PayPal account, which seriously and significantly increases the accessibility of Bitcoin to the average person. You don't have to mess around with things like wallets or exchanges necessarily anymore if that is accessible through PayPal. So there's been, as has often been the case with Bitcoin, a lot of change in both the value and the way it can be used and transacted over the last few months, and we expect that to continue. The decline in price, that may make donors a little less willing to give, but on the other hand, I do think that the specter of pending regulation may make donors want to divest their cryptocurrency positions, including through charitable giving, prior to any regulation going into place. So we'll see what this year holds. But last year, we were able to process a number of standard Bitcoin donations. And as Brian mentioned, that's ongoing even today, working on another one that we expect to go through tomorrow. Normally, the process is relatively simple. Donors will get on the phone with us, and we will give them our unique ID number, kind of like an account number. It goes to our wallet on the exchange that we use, which is the platform we use to sell cryptocurrency. So we give them the address. They'll send a small amount, like $20 worth of Bitcoin, a tiny fraction of 1 Bitcoin, to us. We confirm receipt, send them a phone call or an email, and then they send the rest over. As soon as we see that, if we're talking Bitcoin, it's heavily traded, it's easy to sell, there's no volume or market issues. We can usually sell through all of the Bitcoin in minutes after receiving it. It settles right away on the exchange we use, Kraken, which is one of the major Western exchanges. And then we immediately initiate a cash withdrawal to our bank account. So this This process can go extremely quickly when everyone is motivated to get it done. One of our major donor advised fund partners called me on December 31st at about 1 o'clock in the afternoon, said they had a donor who wanted to do a Bitcoin donation last minute. This donor advised fund could not accept it on such short notice. After some hemming and hawing, I decided that we could take a run at it. We got the donation completed, sold it, and initiated the wire all by the close of business on New Year's Eve. So it was something that was entirely wrapped up in a single afternoon. Not my favorite thing to do, probably not the donor's favorite thing to do either, but these donations, when it is a cryptocurrency like Bitcoin that is easy to accept and easy to sell, it can be very simple and very fast if you're set up properly to do it. And we've considered, based on that experience, some more complex structures. We've had conversations about funding a charitable gift annuity with Bitcoin. We're not sure if that's ever been done in the country before, so that conversation is kind of ongoing, but we've definitely seen several charitable remainder trusts that have been funded with cryptocurrency, particularly Bitcoin and Ether. And I'm sure some of the valuations Brian mentioned he's done this month have been for that purpose as well. It's advanced and sophisticated planners have been wise to that tactic for a few years now. So the other donation.
You might even want to mention, Brian, too, that what a couple weeks ago, I guess we had a prospect reach out about could we accept $1 million of Bitcoin for a CGA? So it's now sort of going downstream from sort of the national DAF to the community foundation sort of platform, generally speaking, to maybe some larger charities. Very few are sort of in this space, just to be very, very clear. If 10 are doing 90% of everything, I'd be surprised if it's that many. So it's a lot of conversation around it. Very few are actually doing it. Then sort of that CRT space, and now sort of down to potentially the CGA space. So it's not as linear as that, obviously, in terms of the evolution. But to even have that brought up, I would never have thought of that, a year or two ago, to be sure.
Yeah, it's become. I think charities are getting somewhat more comfortable with the asset, and they're learning more about how to accept and deal with it. One of the problems in 2017, 2018, everyone knew about Bitcoin, but most people didn't know how to accept it or even what it meant to own Bitcoin. Things like setting up a wallet, getting on an exchange like Kraken or Coinbase, these were very, very new concepts to everyone, particularly in the charitable space. But now we're seeing quite a bit more education and really the kind of standard gift planning thinking is being applied more and more often to cryptocurrency. So, and the other donation I wanted to talk about was what's called an altcoin. 35% of the total value of the cryptocurrency market is in altcoins, which generally just means a cryptocurrency that's not Bitcoin. Bitcoin's about 70%, 2/3, 60% sometimes of the total value. Everything else is an altcoin. These can be more difficult to sell. Sometimes they're very thinly traded on the major exchanges. Cryptocurrencies like Ether and Bitcoin Cash, those are altcoins, but they're very large. Those are easy to sell, but there are hundreds, and those other hundreds often are not very liquid. So we were approached about that. It was a large donation. It was multi-million. So we were hoping to find a way to make it work, but we knew we weren't going to be able to sell through it all quickly because the daily volume was about, I think, maybe $7 million on the exchange we use. We were not going to be able to sell through a multi-million-dollar donation on that exchange very quickly. This was a little concerning to us because the longer you hold cryptocurrency, the more of a security risk there is, not only because of the standard price volatility that you have, which is not really a security risk, but it's a risk to the value. And then security risks of theft or loss. 20% of all Bitcoin ever produced or owned has been lost, some studies indicate, and you've probably seen horror stories about people losing $250 million worth of Bitcoin, or having it locked up or thrown out on an old hard drive. Those stories are real. We have encountered that through Charitable Solutions in our personal experience as well. So very real security risks there, particularly with altcoins where you don't know how quickly you're going to be able to sell it, meaning how long are we going to be holding on to it. In this case, the donor actually had contacts with market makers who could arrange for the sale of this altcoin. The donor put us in touch with the market maker. We understood what the process was going to be, all done through an encrypted messaging app. Donor said, okay, I'm going to transfer title over to you, Decamite. We took title to it. Market maker gave us an offer. The offer we understood to be a good one with the advice of the donor and his advisors. We accepted that offer, quickly received a wire for the sale proceeds, and I think are making a grant for it tomorrow. So it ended up being a rather painless process for a very difficult type of cryptocurrency, something that without going to the market maker, we would never have been able to sell through in such a short, compressed manner. It was a very smooth process using that market maker rather than having to go through an exchange. So that's something that was a bit of a learning process for us, just because these altcoins are typically something that involves a lot more planning than just normal Bitcoin, if you can even ever call Bitcoin normal. So that was a very interesting process. So I think now Brian's going to talk about the foreign real estate deal.
Yeah, so on the foreign side, we got a case that came up about 3 weeks ago. We'll sort of see how this plays out. But basically, it was a donor in France. She had passed away, left a chateau, so it probably conjures up all kinds of images in your mind. So not a small house, but not quite, the Downton Abbey kind of deal either. But anyway, has the personal residence, and I think it's like 10 or 12 paintings there. And so the university has been able to receive through the estate settlement most of the liquid funds, which were significant, and now is getting quite jammed up on now what do we do with the illiquid side. So Gary Snerson on our team, again, we got a team of 16 at this point, but he's able to has some strange level of expertise with foreign property. I don't even know what it is, Ryan. We own like 120 acres in Uganda or something right now still. So love to have an offer on that if anybody is interested in a Ugandan retreat here on the phone today, but I digress. So the French estate, and so we are working potentially be able to receive those gifts in kind from the estate into Decamite Foundation to the Donor Advised Fund. And then we would go ahead and obviously process through, as we do any illiquid gift, and then to be able to make the final proceed transfer by grant over to the university. So anyway, that's just one thing that came up. We would say maybe 2017, something crazy, like 20%, 25% of all of the gifts by value, so not by number but by value, were actually foreign assets. And so international assets, I think that people are sort of surprised to hear. So we currently still own a $100 million plus captive insurance company in Bermuda. We took in a $53 million of actually a cryptocurrency exchange in British Virgin Islands. And so we've dealt with property in Hong Kong, and we own or will own a strangely large amount of Central America with a donor that it's a great example, sort of doing the two trends together. So he's in his late 70s, has a ton of property in Panama, Costa Rica, and Belize, and a lot of gain. And then so what he's doing, as he sort of needs to year by year, is transferring in that international property, claiming that full deduction, getting that sold. And he's like, look, all I've ever done is real estate. So now I want to be able to reinvest those proceeds into triple net lease properties. You can Google that if you're not sure, but very sort of passive bond-like investment, low management properties. And so then we'll do that domestically. So he sort of is over time culling out his Central American portfolio. We are then processing all of those through and then turning around and then reinvesting that in higher income so that he can make more grants, which is his goal, and sort of doing that over life. He's single, doesn't have kids, and so his basically goal is to say, I'll just keep doing this as I can use the deductions each year, but anything that I've not yet given away, I'll just have all of that spill over through my estate and then sort of to reconvert in the same way. So just a quick point about the foreign real estate. So Ryan, I guess you're going to talk about the testamentary real estate domestically. So Case, I guess you just worked on, what was it, a week and a half ago or so?
Yeah, some recent communication on some final items with the donor. So this was a case where the donor was working with a local community foundation, and they had a home, their home, so not an income property or a vacation home or anything like that, their primary residence, that they wanted to leave to this community foundation. That city, a very, very strong real estate market. There's no question that the home will retain its value over time and likely appreciate quite a bit. The home's already very valuable, but the community foundation was still not able to accept the real estate. This was a community foundation that we've worked with before. I think Brian has had contacts there for many, many years. So they reached out to us to see if we would be able to step into the community foundation's shoes and accept the home from the donor through their will. Based on how strong that real estate market was and the expected value of the home, it was not something that really gave us any discomfort. It's not, none of the complexity that Brian just talked about with foreign real estate comes really into play with something like this. If it was an outright lifetime gift, we would have had no problem with it at all. So the testamentary element was really the only thing that was any different. So we worked with the donor and their attorney to draft up the appropriate language to name Decami in the donor's will as the recipient of the home. And at the same time, the donor created an unfunded donor advised fund with Decami with a grant recommendation that when we do receive the home and sell it, we would then make a grant of the cash over to the community foundation. So we would be doing the same thing that we normally do with lifetime gifts of real estate, just done through the testamentary mechanism. So this is something that we do see a little more often these days. This is not the only example we had like this. I think a lot of donors really like this option because working through the will, it's revocable, right? If they change their mind, all they have to do is change their will, and it's, they can completely change their plans as their life changes over time. So a lot of times I'll suggest a retained life estate, which can be a great solution for the right donor if they need an upfront tax benefit. But of course, once that's done, it's set in stone. Testamentary real estate option can be much better for certain donors who are looking to retain some flexibility with their charitable planning. So that has been really good. There have been other cases where we've had charities approach us not realizing until they were notified by the executor that they had been named in the donor's will to receive some real estate. And we've been able to help out in cases like that as well. So starting to see a little more of this. And I think the testamentary route is really good because of the flexibility that it offers. So,
a couple quick points, and a good Q&A just came in. So Bill, good question. So the question was, why not just have the personal rep sell the property first? That clearly is ideal on so many levels. To a point, I guess I would say, from our experience. So in the first case, this is a single woman, no family, like zero family, and she wanted to set up her entire estate so there's no probate. So her whole issue basically was just to have it ideally go sort of directly to us. So we're sort of working through that sort of to the extent that you can, obviously. So still would do due diligence and everything else sort of as necessary. So obviously with TOD or POD, just sort of depends. But that was sort of her thing, is saying, I don't want to have any sort of, and if it does go through an estate and it has to go through probate, I want it to be just very simple, not burden any other person with doing this. So that's sort of number one. Number two, we strongly encourage, because each state's obviously so different, that, as Ryan said, we'll have charities that will call us and say, look, there's real estate or art or something sort of wacky but of high value within the estate, and we don't want to take that in directly. And for whatever reason, the personal rep or executor either doesn't want to sell it, doesn't have the skills, and what we generally find is sometimes, and this is, again, very general, of course, 3 to 6 months of stamina. I'm going to try to sell the houses. It's 2 states away. I'll give it my best effort. But after 6 months, what we again start to find is executor or personal rep's like, I'm kind of done. I've done all this stuff to the family. Charity, this is going to you. Now this is my burden. Okay, I'll get it sold. It'll be sold by next Friday. And yeah, it's worth $1 million. I'm selling it for $600,000. You ought to be, and everybody's heard this, you ought to just be happy with whatever you get, kind of deal. And so that's where it can get a little bit funky, where it might be better to have that as an in-kind distribution, to have a more, let's say, prudent value maximization sort of process. So long story short, in many states, it can be very, very problematic. If a specific charity is named to receive the direct gift in kind, they can't sort of slide us or some other third party in there. Some states it's somewhat easy to do. Other states it's a nastier, longer, more expensive process. And so even in her case, this case that Ryan just mentioned, we encouraged her to say, look, this community foundation may have more comfort taking it in 3 years or 10 or 20 years from now. We don't know. So why not include a potential in-kind disposition to either the community foundation for your named fund there, or to the Decamai Foundation to then have a standing grant recommendation for your named fund at the community foundation. So now you've got 2 paths of potential portals that you're not necessarily having to go back and get a judicial sort of agreement that you're able to sort of repurpose that potential donation. So having a little bit more flexibility tends to make a lot of sense. And in some cases, too, certainly we see that the personal rep or executor has much more authority to be able to allocate where that goes versus a direct, specific sort of bequest of that real estate. So just some comments. But this comes up probably every other month now in some way. Either they're planning their estate and including that in there, or we're getting a call from the charity going, we can't figure out how to extract it, and we don't want to disclaim $500,000 of a condo in Williamsburg, Virginia. But how do we get that when we don't want to take that in directly? So, yeah, so S-Corps.
Yeah, another category of gift that we see a lot of, and particularly last year, real estate, as Brian mentioned, is always a big category of donated assets for us, whether residential or commercial or even vacant land. But S-Corps, we saw quite a bit of activity there. An interesting business type from a charitable perspective can be quite complex. As I'm sure most people listening to this know, charities are effectively not tax exempt to the extent of S-Corp holdings, meaning any gains or ordinary income are all taxable. In our case, we have a structure designed to mitigate that tax effect, where we hold the S-Corp donations in a supporting organization in trust form that is based in the state of Nevada. So with Nevada, there's no state tax. And because it's a trust, it is subject to tax at the individual rates, but it also, when it turns around and it grants out the cash from the sale of that S-Corp, gets a tax deduction deductible at up to 60% of AGI, which reduces the effective rate by 60%, meaning capital gains, instead of being payable at 20%, are payable at 8% ordinary income instead of 37% is 14.8%. So there's still tax being paid, but it's significantly less than what it would have been in the donor's hands, particularly if the donor is in a high tax state like California or New York, Illinois, something like that. So that's kind of our standard structure for S corporations. In this case, it was interesting because most S corporation donations we get are a standard stock sale or an asset sale. Sometimes there's a more complex maneuver like an F reorg being done. But this was even more specialized than that. This was a case of the three owners of the business selling the S Corp to an ESOP, that's an employee stock ownership plan, basically selling to a trust where certain employees, as a result of their benefits plan, got an ownership interest in the company. The way that those sales are structured almost always involves a note component because the employees don't have the money to buy the business outright. So there's always a seller note being made. In this case, the three co-owners were all going to give to different charities and all had different roles in the company. So we had to coordinate and make sure each one understood the process and they all had different priorities and different thoughts and questions. But we worked with them in the fall to make sure that all of the paperwork was lined up and the math made sense for them from a tax perspective so that they could make a donation prior to signing the paperwork necessary to sell their business to the employee stock ownership plan. It ended up being that we would receive no cash from the sale and instead take back entirely a note. Sometimes the note component is 30% of the overall value or 60%. In this case, it was 100%. That's quite unusual. We don't see many of these donations to begin with, let alone when it is a 100% note payout. So we took the note. In this case, we had to review the terms. We were comfortable with it because the interest percentage, the interest payable on the note was quite significant. If it had been lower, like the AFR, we probably would not have been interested in carrying a note for a decade. In this case, it was quite a bit higher. And I think that was appealing to the donors as well, because the idea that I think was appealing to them was that they would get the tax benefit from the donation up front, and they wouldn't get the cash up front, but it would still come out over many, many years, and they could count on a certain annual amount of cash being freed up for their charitable goals. For some donors, that does become quite appealing, just knowing that that amount is out there. So that worked rather well. We didn't get any cash and haven't gotten any yet. I think the first payment is in 5 or 6 months. But it was a way where even in this complex S Corp space, we were able to think of a solution that was going to work. The tax that was due, the unrelated business income tax, that's going to be spread out over the term of the payments because we get installment sale treatment. So that was an example of an S Corp of which we get 12, 15, maybe 20 last year. We get a good number of those every year. They're always complex. This one maybe more so. So a really interesting example of complex business donation when you see that sort of planned business exit that Brian mentioned earlier.
Well, I mentioned to Ryan, he wasn't aware of this, but even this morning I got a somewhat similar situation. It's a perspective. It takes 8 leads for us to close one, so who knows. But similarly, where it's a client that has a very large S Corp, they want to sell it to their kids, basically in probably a defective trust, and then the donors, then the sellers, would take back the note and then donate the note to us, which might be a 10 or 15-year note. So many charities are not overly comfortable holding any illiquid asset long term, but especially a note. As I always say, notes work wonderfully until they don't, which we all learned in 2008, 2009. It's like, oh, just collect your checks, no big deal. Yeah, until the check doesn't come, and now you got late fees, and now you're like literally suing the kids of your donors. That just gets to be a joyous prospect. Never mind if there's collateral and security under the note that otherwise needs to be foreclosed upon, and legal action, et cetera. So, but long story short, we do again a lot of S Corp transactions, probably in the 100 million or so per year ish. Especially if you include active business LLCs, which would also have the UBIT flow through issues as well. So do a lot of the UBIT space because of the trust form charity that Ryan mentioned. So let's go to the next one. I think it's the reinsurance. Yeah. So Won't spend a lot of time on this one per se. I'm getting more questions about this. Given some of these really large gift annuities that I mentioned, one of the trends definitely that we are seeing. And so this is a case we worked on actually for 3 years. So they called us initially and said, we've got a donor now that represents about 60 or 70% of our not gigantic gift annuity pool. And it was about, I think, 5 or 6 million at that point. And so we started doing some analysis, and then as we were doing the analysis, then he added another million, and then another million, and then last year he said, look, I want to add another 5 million. So it accumulated 8 donations of $1 million or more. This extra 5 million would have been a $15 million gift annuity on, I think it's like a $17 million pool, and so it doesn't take a pricing or risk actuary to say that that's a problem on a whole lot of levels. So they were going to decline the gift. They were just going to say, do not give us the $5 million. We just cannot stomach any more sort of single life risks. So we have 2 actuaries on staff, part of our team, do a lot of these sort of risk modeling, optimization modeling on CGAs, pools more broadly, but also specific large concentrated risks. And after a lot of modeling, sort of proposed a 50-50 equity reinsurance split. So reinsurance, to be very clear, is simply a way that charities can purchase a commercial annuity. It's as simple as that exactly matches the liability under the gift annuity contract. And to me, interestingly, maybe not to you, it's really, in many cases, the same products are used in the corporate defined benefit plan space because they have a corporate liability to their retirees. And so many corporations will say, we do not want to take the investment and mortality risk. That can throw earnings off up and down. Would like to sort of immunize that. So we'll go out to the insurance marketplace and say, how much do we have to pay to, in essence, transfer or shift de facto this risk to the insurance company, and we're sort of done on day one. And so again, interestingly to me, a gift annuity is precisely the same thing. It is typically a corporate legal obligation, contractual guarantee to make those payments, so it has to be owned by a corporation that happens to be a charity. And instead of obviously retirees, they're simply to annuitants. So it really works exactly the same way. So long story short, in this case, we had to go to 3 different insurance carriers because even that risk was too large for any of these billion-dollar-plus pools to take on. So like one case was like, we'll take $1 million, that's it. We will not take $1 million at any price. And I sort of bring that up at twofold. One, it's still surprising to me after so long that so many charities take in very large gift annuities, not really realizing some of the risk that entails there, again, generally speaking, and that even a very large insurance company says, we will not take that risk into our literally tens of thousands of person pools because we can't smooth it enough at that size. And meanwhile, charities are doing it every day with 30,000, 60,000, 40,000, 2.2 million, 30,000. It's like, whoa, where's that 2.2 million one sliding in there? So it tends to be the best gift that you'll ever receive ever, or it'll be the worst gift you've ever received ever. So it tends to be very binary in terms of how that plays out. But in this case, the immediate annuity that again exactly matches the annuity payment is all fixed income, 100% fixed. So if you have the reinsurance piece at 50%, all fixed income, and then you basically take, in this case, they took the other 50% that remained, invested that all equity, diversified equity. They're right back to a 50-50 portfolio, same thing. And if the donor dies immediately, they still have 50% left over. Not good, but they got 50% left over. And their huge concern was this guy was like wicked fit, and they said if he lives a long time, we are going to get really sideways. $480,000 a year payments to one donor. They said that's not comforting. So in this case, they said this basically is like we're buying a fixed income equivalent, but with a super longevity kicker, because if he keeps living, it keeps paying. So it's really shifting that longevity risk over to the insurance company. So long story short, it dropped the modeled exhaustion risk down to 0, able to project, interestingly, a much higher ending balance or residuum at life expectancy, even like 2 or 3 years prior, because it became such a large portion of their pool, they started investing it more and more conservatively, so concerned that they were going to run negative. And so in this case, they were down to like 25% or so equity. Like, okay, if we can shift that longevity over, will go from 25% equity up to 50%, and that should be able to smooth better over time because the immediate annuity, the reinsurance, was taken over about roughly 80% of the total payment anyway. So this just finished this about a month ago. We did about $20 million or so in reinsured gift annuities, all very large ones like this, and usually much more of a one-off. So it doesn't fit always. I've had a couple of people on Tuesdays say they'd like to have maybe one of these webinars just on reinsurance again. So I might be doing that maybe in April or May or something. But anyway, it's coming up more because many people took them in at the wrong time. Nobody knew it was the wrong time when they took them in, because I've never had a call where they're saying, look, we're really concerned about this $5,000 when we took in 1999. Never had that phone call. The phone call I get is, we just got the person that took in the $1.8 million one in 1999, and now she's 104 calling from Hawaii after winning the Senior Hawaii Triathlon Olympics for the 5th year in a row, and they're going, oh my God, we are so underwater on this thing, we can't ever get back out. And so those are the calls that we get. And then painfully, then the CFO's knee-jerk reaction is shut down the pool. So it just is crazy. Now, last point I would make, this is nitpicky and snarky, and it's on webinar or whatever, or recording. But it's so funny to me because we did one of these cases with another university, I don't know, maybe like a month and a half ago. And one of the persons on the line finally sort of said, she goes, I sort of get it that we never view any of these CGAs as risk at all. But in every area other than the university, we're like super risk, kind of freaked out. And we sort of went through the example, which is true. I said, I'll guarantee you that if you lost your laptop today, if it was stolen today, you have that covered under your commercial property policy, and it's $500. Who cares? It's $500. But in this case, they had a $2.8 million gift annuity that was not insured in any way. I mean, that's where it starts to go. That's a little bit wonky from a risk management perspective. So I digress. So might do one of these again, topics. We're probably going to do something, by the way, with Russ Willis next month on prearranged sale issues, so post-Dickinson, so some of those cases. So we're sort of lining them up for the rest of the year, but might be doing one again on reinsurance here shortly. So with that, all sounds good. I'll maybe pitch it back over to Ryan for the other interesting gifts that have sort of popped up of late and last year.
Yeah, just some quick hits on these final few interesting items. We did a long-term hold of a very large restricted public stock position. That was interesting because we were actually approached by the company itself. They were looking to start up a corporate charity, wanted to devote some stock that they had to issue to us. They wanted to devote that to charity right away, but obviously didn't have the corporate charity set up yet, the corporate foundation. So we were able to accept that, worked with corporate counsel, made sure that we were checking all of the boxes and complying with all of the necessary securities regulations. It ended up being quite a large position, but it's something that we are just going to be sitting on, and I think eventually will be moved over in whole or in part to the corporate foundation, which was very interesting for us because we get very few contributions from corporate entities, sometimes from things like partnerships or other pass-throughs that are really just working for the individual donors, but in this case it was actually a corporate donor. Somewhat similar was from an individual donor, a cash donation, with the idea being that we would then turn around and invest in an SPAC, a special purpose acquisition company. Those have been in the news a lot lately, have become a very popular way to take a private company public. This donor was deeply involved in that space and was able to arrange for us to have the opportunity to participate prior to the public offering, usually done by a way of subscription and then funding that subscription prior to the company going public. So in that case, worked with the donor, received the cash, wired it over for the subscription, and received eventually the block of shares associated with the SPAC. So that was very interesting and has become more popular. It was something I don't think had ever even heard of a couple of years ago, but completed that successfully over the summer and into the early fall. And the final item is an LLC holding strip mall, again, a long-term hold. This was a very valuable strip mall, and the donor owned it outright with no debt. It was hugely cash flow positive. Normally, as I mentioned with testamentary real estate, with any kind of real estate, really, we're trying to sell as soon as we reasonably can. In this case, the donor's intent from the start was that we would hold on to the LLC and receive the rent payments long term. So that ended up being actually quite like the motivations of the donors with the ESOP, where they were happy to get the payments over time and fund their charitable goals over a period of several years. Same thing with this strip mall. It's generating a ton of cash from the rents, and it's just going to be something that we receive, get those payments on a quarterly basis, and then turn around and make grants to other charities based on the rent received over a period of several years. I think it will be probably over a decade when all is said and done. So that was an interesting case as well.
Well, we somehow have covered all of 2020 in 50 minutes. So I appreciate that, Ryan. Very good job as always. And I thought Tuesday's call went really well. I think this may be the keeper. So we'll maybe use this one for the recording for next week. So again, the sort of quick follow-up, we will send out to all of the attendees, and I think actually registrants, we send out the link once that's posted, hopefully by Monday or Tuesday of next week. We will then consolidate. We had a number of Q&A come in, but they are actually directed just to the panelists. Even better. Yeah, thank you, Ryan. So Ryan's actually sort of jumping onto the resource section, which has the other ones. You can see we did a whole thing just on cryptocurrency. Isn't that a joke? It was 19,000 when we did that one, so we all should have bought heavy at that point. Missed out there. And then we, one on mortgaged real estate. And you'll see a bunch of other ones there at the bottom too. So we'll send that out with Q&A. Any other topics you think within our lane? We're a one-trick pony, and we get all excited when people ask us to do our only one trick. But if we can be helpful. But the main thing is, as we sort of close, I hope that some of the trends were helpful, some of the actual case studies. Again, none of this was theoretical. But please, 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 whether it's us or some other provider, do not say no to a good donor with a good asset wanting to do good things. So keep us or others in mind, and if we can be ever helpful, definitely let us know. So thanks so much.
Great. Thank you all.